Good afternoon, everyone, and welcome to Ranch Management Forum 2023. Before we begin, just a few housekeeping notes. If you have questions during the presentation, please type them into the chat box or the question box on the bottom right-hand side of the control panel, and we'll answer them following the presentation. Our webinar is scheduled to take approximately 1 hour today. If we run out of time to answer all of the questions after the presentation, our presenter will follow up with you after the webinar. A link to the recorded webinar will be sent out to registered participants and will be posted to our website, saskatchewan.ca/agriculture, within 24 hours following the live presentation. At the end of the session, you will be prompted to complete a short survey. Your feedback is important for planning future events. I will now turn the webinar over to your facilitator for this session.
Hi, everyone. Welcome to Session 2 of Ranch Management Forum 2023. My name is Ricky Wilson. I'm a livestock and feed extension specialist with the Saskatchewan Ministry of Agriculture, and I'm based out of the Humboldt office. I'll be facilitating today's webinar, which will focus on livestock and forage insurance options available through Saskatchewan Crop Insurance Corporation. Our presenter for this webinar is Jodie Griffin. Jodie is the program coordinator for the Livestock Price Insurance Program with the Saskatchewan Crop Insurance Corporation. She has been in the cattle industry for the past 28 years and employed by some of the largest and most successful companies in the cattle business. The core of her career has been in cattle finance and cattle marketing. She has extensive experience in all sectors of the cattle industry. Jodie, along with her husband, ranch southwest of Saskatoon and run a 250 head cow-calf operation and run yearlings in the summer. When they're not busy on the ranch, which rarely happens, they're both involved in the sport of rodeo and enjoy time with their grandchildren. At this time, I'd like to turn over the webinar to our presenter. Go ahead, Jodie.
Thank you so much, Ricky. Hello to everybody. It's great to be here. I will just correct that I'm going to focus primarily and actually exclusively on livestock price insurance today, just because there's a lot in here that I wish to discuss. And for those of you that are joining and are familiar with me, you know that I have a fairly strong passion for this program. So we're going to get right into it. I got quite a bit of good stuff, I'd say, in this, and to the comments that were made before about Jennifer, I do look forward to a lot of interaction through this presentation. It's hard to do them virtually because, you know, we can't be face to face. So I just want to make sure nobody gets missed. So ask me a question at any time, and no question is a crazy question. Every question is a good question. So we're going to get started here. We're going to do a quick background. I'm going to go through like some of the fundamental quite quickly, because I think because the program's been around for 9 years now, it's hard to believe that's 9 years. I think we all have a general grasp of the program, but I do want to do some quicking update on the background. We're going to go into the LPI, diving a little bit deeper into it, maybe talk a bit about facts and myths that we hear out there that are common with the program, and then of course Q&As. So speaking to the background of the program, and not everybody knows how price insurance came to be, but it definitely was a response from what still today is the largest Canadian agriculture crisis that ever occurred, which was on May 20th of 2003, and it was of course the dreaded BSE. And we all know that from that event that happened in the early 2000s, it forever changed the scenery of the livestock industry here in Canada. So because of this devastating catastrophic event, Alberta producers partnered up with the Alberta government to create something that would give them some form of price protection against those external events that a producer has no control over. And therefore they did create price insurance, and they rolled that out back in 2009. Like, so that's getting to be a while now. So, but meantime, their, you know, neighboring provinces, such as ourselves in Saskatchewan, were looking over the fence going, you know, this program that Alberta currently has looks like it's valuable and should be shared amongst the rest of us. So in 2014, we extended it out to the Western provinces. And so now all 4 Western provinces have access to the program. Now, because this program was created at AFSC, Agriculture Financial Services Corporation in Alberta, they still are the administrators of this program on our behalf. They are still the ones that provide us with all the technical support, and we use their actuarial department to do all the methodology that they do that gets us those premium tables that we see each week and those settlements on Mondays. And they are the experts, and so that was super important that that's where it stays, is where it was created and where the experts lay. However, each one of us provinces, us, for example, at Crop Insurance, we deliver the program on behalf of you, the producer. We are the face of the program for you. You come and see us at Crop Insurance, and we can help you with all your price insurance needs that you might have and any of your questions that you would like to have answered. So we started out as Western Livestock Price Insurance, and then we had a bit of a change. We designed a new logo. We shortened up that name just to be more relevant to the way things are in today's current environment, I guess. And so new look, new name, but it's the same program. Through not through BSE, my goodness, but through COVID, we took some time to start building some more detailed resources for producers such as yourself. And so I put here on this slide here, if you wanted to jot down that address there, or come back to it in the recording, that's fine. But you'd find our buyer's resource guide. It's extremely helpful. It's detailed. It has very good visuals on understanding how this program works and understanding how our settlements work as well. So it's our LPI buyer's resource that you can find at Crop Insurance, in our Crop Insurance page. So just a quick overview, a reminder for many about what livestock price insurance is. It's a risk management tool against an unforeseen price decline in the Canadian cattle market over a defined period of time. So just like this graph shows, when you purchase a policy, you've established a floor. And I want you guys to really remember that this unique tool is about establishing a floor over a defined period of time to protect you from any market volatilities. So when you get into the end of your policy and that becomes your claim window, if the market is below the insurance you bought, insurance is going to pay you the difference. But if the market is higher than the insurance you purchased, it just means you're selling your inventory into a stronger market. And that is going to be quite the highlight of our conversation today. So why should I buy the livestock price insurance? Well, I always go back to when I get asked that, and I say, well, I think you need to ask yourself, why wouldn't you? You really have to stop and take a look at what your individual risk tolerance is. What are some tools that are available out there for you to utilize, besides the price insurance? What's your market read, and how confident are you in that market read? And at the end of the day, can you really risk to do nothing? Those are very important questions, and they even apply today to this rising market that we're currently experiencing. This program, as I've stated, is about something that is there to protect you against those unforeseens. And even though we're in this really positive, bullish market, I mean, I sit and present with a smile on my face. I usually have lots to complain about as far as these markets go, but I dare say that I'm really limited to what I could complain about in today's environment. But we also can't forget that there's still things that are happening out there in the world. We're a global market, and that still speaks to volatility that can lay in the cattle industry. These charts or these captions I put together a while ago, but they're still relevant. We still have the war going on. We all can talk about the economy and what that's doing for us. rising retail prices and how much more is our consumer going to be able to take as they go on and you know, they're experiencing some of these challenging times with interest rates and so forth. And then of course that middle one that is super important still today, and it's kind of the one that is still a little bit of an unknown, and that's our feed grains. We all know what our cost of production has done over the last few years. You know, where do we feel that this is going to land again this year? And all those things are still going to be impactful to where this market stays or goes or whatever. I mean, volatility just always seems to exist. And I would say that now, you know, this program was designed to protect you against those catastrophic events, as I referenced BSE. But now our market today, it has as much volatility in it as those BSE years did. And the moves are so quick and so swift and so furious, and that's due to technology for sure. And we're just such a fast-paced moving market. We just can't control these things any longer. Not that we ever really could in the past, but we definitely don't have the time on our hands that we did back in the day to be able to make decisions because these things are just so rapid. So we have a market information page, and sometimes, you know, you may not know that that actually exists on the website, or you might find it's hard to find. Well, you can go under the About tab you see at the top and go on to our resources and go look at this market information page. All these charts that I'm about to show you next are pulled off of the LPI website because we post this information every week. And it's super interesting to look at, especially if you're a chart person like I am. It's super interesting to look at, and it also helps make sense of why the premium tables kind of look the way they do, why you know, why our coverage is where it's at, why settlements are where they're at. Our marketing information is posted there to take a look at. So I encourage you to take time each week if you can to go through that information. You know, information is power. So risk management tools that are available. I mean, this is the thing, like this presentation here is going to be focused for our cow-calf producers specifically, because that's, you know, the CAP program is currently available and it does have a deadline. But, you know, when we step back and just take a look from the seed stock growers perspective of what availabilities that you have, we're quite limited as cow-calf producers. Like essentially, we have two other forms of risk management that we can do. One would be to contract the cattle, contract our calves for fall delivery, for example, or forward sell our cattle on our online auction markets such as Team and DLMS. So there's pros and cons, and there's pros and cons to everything. So the pros might be on forward, like on contracting or on forward selling, is your price, your currency, and your basis, which are the three main components of the Canadian cattle market, are taken care of for you. You know your price. If you contract the cattle and you forward sell them, you know what your price is. You have a set delivery date. You probably know who your buyer is. There's no cost in contracting cattle. There's cost to forward selling. You might be subject to some commissions there. But generally speaking, there's not a lot of discipline that's required, like needed on that. However, and this is important to talk about, when we talk about today's current environment, and that's that, sorry guys here, I just got to move my screen around a little bit because it's blocking me off. But the most important thing on those forward sold contracts or an actual contract is, of course, you've locked in your price. And so you have no upward potential if the market was to get stronger at the time that you were going to deliver the cattle. And that's always important, and it definitely could be important in a market environment such as we have now. There is some discipline that is required, even though I said maybe not, and that is because each one of those risk management tools, they'll have specs attached to them. You will be required to be able to deliver as you described. You know, so I think we're all familiar with what that is. It also tends to be a bit of a numbers game. You know, it takes quite a bit of cattle to be able to contract them and even forward sell them, and so that to be attractive enough to a buyer. The most important piece here, things that I've kind of stopped talking about but needs to be talked about, is that force majeure clause. So our focus in our conversation here today is talking about external risks. And since BSE, what we did see happen on those contracts now and forward selling is now those contracts most likely are going to have a force majeure clause attached to it. And what that means is that if something was going to happen, such as that would create a border closure, that would mean that contract and potentially that forward sell would have an option to renegotiate price. Price insurance is the only risk management tool that does not have a force majeure clause. So the example of that is if we were to get foot and mouth disease to hit us here in Canada, I hate to ever even say that out loud, you guys, because we know that that would be the worst of the worst of the worst that could happen to us. But let's just say it did, and you held your LPI price insurance policy. That policy stays alive. It is not adjusted. What may happen, and most likely would happen, is if we ended up with that massive, like if we ended up with foot and mouth disease that closed our borders, it most likely would take some time for our markets to reestablish themselves. So it would just mean that your settlement period has the potential to change. And it would change and just move along with when the market would recover itself. But the liability that's attached to that policy does not change. That's an important thing. And, you know, those are just some of the things that we've been talking about lately throughout the industry you know, when we talked about BSE and we talked about foot and mouth. But again, I don't want to say that too many times because I don't want to jinx anything. So when we get down to the price insurance, so you get the same components as you do as contracting, covering off those areas of risk. The thing is it establishes a floor and gives you that full upside market potential if the market were to rise. There's no force majeure clause. And the policy is honored through those catastrophic events, such as a border closure. It's regional pricing. It's there's no specs attached to it because it's market insurance. It's not production insurance. It does have a cost attached to it, of course, and that's our premium. But that's just like, these are kind of the only tools that we have as a cow-calf producer. So it's always important to clearly as you can, evaluate those tools and find out which one has the best use for you. How to get started in the program if you are not is super simple. Come onto our website, fill out your forms, register to get those weekly emails so you can be tracking those coverages as they're being published on the premium tables, as well as those settlement prices. And then you can create your online account and be self-serving and able to conduct all your own business using your computer at home. I've talked about those 3 areas of risk, so I'm going to get into them. We're going to talk about those 3 main components that premium calculates for. So the first one we talk about is price, and that price is coming from the futures market, which is the Chicago Mercantile Exchange. And I mean, oh my goodness, you guys, like, just, we're in a whole new world. Like, we legit are in a whole new world. Coverage that's being offered on our program right now is historic. We have never covered this level of, like, we've never offered this level of coverage ever in the history of price insurance. And, you know, these charts just really show where we're trending and where we're starting here for 2023. And then further to that, and this is supporting what we're seeing, is what's going on with the Canadian dollar. You know, and that dollar is trading under 74 cents at this current time. And that supports these prices that we see. The lower our dollar is, the stronger our Canadian commodity becomes, as we all know. So that's our currency currently supporting it. And then this is the basis, and we all talk about the basis quite frequently, but maybe not in detail. And how do you? Because when you look at a chart like this, it's like looking at a 4-year-old who's been on an Etch-a-Sketch. The most important thing that you need to know is that the basis piece is extremely volatile. It applies every transaction that we trade cattle for. And this chart tells us right now that we're trending slightly below what we would say the 3-year average. However, we're better, and we definitely started out better than we've been in the last 3 years, and now we're a little bit below. So where you see 0 is, that would mean the feeder cash to futures basis is equal. When we get up into the pluses, that means the cash market is better than what the future market is. When we're below that 0, it's a negative basis, and it means that the feeder cash is at a discount to what the future basis is. And there's other ways to calculate basis as well, and I'm not going to bog you down in that detail. But it's just important to note that it's extremely important. It's a big factor and a big piece of our Canadian cattle prices. So we'll focus back onto the CAP program, which is now available, and just kind of just a refresher of what qualifies to be on, like what the components are and what qualifies. So this is intended for all weaned calves, unweaned calves, sorry, not weaned, unweaned calves. So definitely producers today are buying insurance, and they're maybe not set to start calving until May or June. That doesn't matter. What matters is when do you intend to market those animals? When do you intend to have market risk? That's the whole basis of this program. It's based on an average 600-pound steer. Data that we collect when we talk about measuring those weights is we'll only collect 100 pounds, 550s to 650s. To come up with those prices, what we do is we take the current feeder forecast that we have, and the reason why we do that is because there's no such thing as a calf futures market. So we take the feeder forecast, we apply a spread, so that's the difference between what feeder cattle are trading for in calves, and then we apply a barley component. And that just, speaks to feed cost, whether we're feeding the cow or we're feeding those feeder animals. That is what goes into the coverage components. Then after that is done, and when we run those numbers and do that methodology, when you're looking at those premium tables, be reminded that we offer out 95% of what we forecast that day. So each time you look at a table, you're getting 95 to 75% of what that forecast is. And I'll show that again when we do see the premium tables, but we do not offer up 100% of what our forecasting is. We hold back 5% and we publish at 95. It's available for you to purchase in the spring for fall and next spring settlement, and policy lengths will run from 16 to 36 weeks. We won't see that right now, those shorter term policies, of course, because it's too early, but as we get moving through the calf season, you sure will see those varying policy lengths. This is a question that gets asked to us all the time. Why do we not have a premium table for heifers? That's a good question. The program was designed to align as close to the underlying of the CME feeder cattle futures contract. And the CME does not use heifer data. They only use steers. Steers from a settlement side is what we can most consistently rely to flow through the supply chain. Whereas heifers back in the day, had other avenues and other directions that they would go, such as being retained to go into the breeding herd. Now, of course, one can argue that that has not been happening for quite some time. So we definitely have seen a lot more heifers on the market than what traditionally we had before. But the other issue per se that we have is the one that you and I are very much aware of, and that's the steer to heifer spread. And that disparity between the steer and the heifer is very much alive and well. And so this is last fall. I went right from the end of September right till Christmas, right getting into Christmas time. This is what our 550 weight steers were averaging compared to what our 550 weight, heifers were trading for. So visually we can see that there is just such a difference in marketing between those two genders, the steers and the heifers. But what you need to understand about that though is we just insure the exact same way as the steers so that we can be comparing apple to apples. LPI does not recognize gender, doesn't recognize individual weights, nor class of cattle. It's about ensuring weight and understanding that when you buy your insurance, you're measuring that of an average 600-pound steer. And when you go to settle on the policy, it's the same. It's based against an average 600-pound steer for that apples to apples comparison. There's two premium tables which we're all aware of that are available to our producers. What some producers maybe don't know or didn't realize is that it is 100% voluntary to you as a producer to choose either one of these premium tables to select. Maybe you're a producer who consistently sells your cattle to a feedlot in Alberta, therefore the Alberta premium table makes more marketing sense to you. Or maybe you're on the east side of the province of Saskatchewan and you tend to go east with your cattle, so then the Saskman premium table makes sense to you. It's completely up to you. It doesn't matter where you're living. You can choose to use either one of these regions. You just have to be mindful of when you select that table, that is the region and the market that you are following through the lifetime of your policy. So this is exciting stuff. Let's take a look at what's happening this week. So this is the premium table as of yesterday. So already, like, what are we? We're just into March 1st. So we just finished 4 weeks of calf insurance already as February is done. Yesterday, we told you that top coverage. Oh, I'm sorry. Again, I'm missing out here. I want to quickly talk to you guys about how to navigate yourself through the world of the premium table, because sometimes it gets kind of difficult. So you have to ensure that you've got the proper date, because we do have historic premium tables that you can find and go back and look at. Make sure when you're looking at the premium table, it's for the day that we are offering, and so that that's not misleading to you. The second is, before you get over to see what the dollar values are, you have to look to see what your policy length should be. When does this affect you? What market are you trying to protect? So in the case of here, is it 32 weeks? It's going to expire on the 16th of October. That would essentially give you coverage for the last 2 weeks of September and the first 2 weeks of October. Is that reflective to you? So it's important to look at your premium second, or your policy length second, sorry. Then you go over to the insured index or the coverage and look to see what's available for coverage for that time frame that you're selecting. And then all those numbers in the middle become the premium, and that's the cost associated to it. Everything is based in hundredweight. This is how you're going to insure. This is how we publish coverage and premium, and that's how we settle, because that's how the markets work. Now, back to the excitement. I kind of got ahead of myself there. So yesterday, we told you that in the last 4 weeks of your policy, if you selected that 32-week policy, that's when we're going to focus on. If an average 6-weight steer fell below $1,824, Price Insurance would pay you. The costs associated to that, there we go, was $48.24 a head. So we said for $48.24 a head, you could insure a floor price of $1,824 per head on top coverage. But there's a reason why we have more numbers than one. So let's go down to the mid-range of what the premium table told us yesterday. So for just a little less than $100 a head more, or less, sorry, at $290 coverage, we said $290 coverage gives you $1,740 a head protection, established as a floor, and the cost associated to buy that yesterday was $25.32 a head. Okay, the lowest coverage that you possibly could have gotten yesterday. So when we get to the bottom of the premium table, I always refer to that to BSE insurance or fire insurance. Just kind of like, I just want to put something under there that's worst case scenario. I know that I have protected myself in some way, some form. Well, that yesterday was $1,656 a head at $278. The cost associated to buy that was $16.80 a head. Crazy. We're looking at coverage at levels that we have not ever consistently sold our calf inventory at. Okay, when we talk about premium rates, two factors that impact premium. Number one is volatility in the marketplace, and number two is time. Usually speaking, the further out in time we have to go to forecast a price speaks to a higher risk. But the volatility piece is the biggest one. Volatility, as it ebbs and flows, you will always see that impact what the premium rates are going to be. So let's look at LPI premiums through the lens of insurance. This is super important. We all buy varying degrees of insurance. But as a purchaser of insurance, we're always interested and always gauging what our premium percentage off of your coverage is, like how that premium cost relates to the coverage that I'm receiving. So don't just look at that high top coverage was $48 and short change. You have to look at it through the lens of an insurance policy and see what that means as premium as a percentage of coverage. So yesterday at the 304 with the 804 premium, that was a premium percentage of coverage of 2.64%. 2.64%. That middle coverage is less than 1.5%. And then the bottom coverage that I spoke about as being fire insurance, it's hovering around 1%. Those are very low percentages in the insurance world of premium as a percentage of coverage. And to remind you, last year, looking at top coverage at this exact same time was running at about 3.6%. And that speaks to that volatility that we had in the markets in recent history. Whether we were talking pandemic or we were talking drought or we were talking war or we were talking about inflations. That was the driver there. So we have got a decrease in premium rates. Well, off of yesterday's table, it's just about 25%. Super important, super cost-effective risk management tool today. So if we go over the last 9 years that price insurance has been around, it's also important for you to understand, like, this is kind of like the average, this is the buying pattern that our producers have done over the last few years. They definitely don't, on average, gravitate to top coverage. They don't. They tend to go into the mid range. And even with those high premium year costs that we had through COVID, they still averaged about $26 a head that they paid for premium. And the average amount of calves that we've been insuring over the last 9 years is about 12.5%. So maybe we would say that that's less than stellar. We definitely would like to see that percentage insured higher. What you need to know before you purchase your insurance is that A, it does not guarantee a price on your cattle. This is not production insurance, it's market insurance. Insurable weight is used to determine premium cost of settlement policy. That's how you do the calculation. It establishes that floor, and that indemnity will be paid on that calculation of the weight that you did insure on that policy. When we talk about the claim windows, that claim window occurs in the final 4 weeks of the life cycle of the policy. So in this example of a 12-week, it'd be weeks 9, 10, 11, and 12. How we come up with those settlement prices is we're using actual market data that's coming into our system every week from every auction market across Western Canada, including Team and DLMS. And we currently have about 42 markets that are reporting. So extremely robust, extremely relevant. So once that data comes in, when we're going to start settling those policies on the CAP program for the fall, is we're going to use that 100-pound range that I spoke about before of the 550s to 650s. And the reason why it's set there is because that speaks to the bulk of the calf inventory that we have at that time. We don't make any adjustments. It's an average 600-pound steer price that we're examining. And we do have outlier rules such as a 1 and 2% or 1 and 2 head drop. And what that means is, when you're sitting in an auction mart and you see a single come in or two head come in, we usually call those the outliers, right? Like they're just not making the average draft of cattle that come through. So we'll eliminate them. And then we do apply what we call a daily mean. And what that means is that takes out the highest price, like, what an inflated price that maybe would represent, say, a 4-H steer. And then to the lowest price, that may speaks to the third cut cattle or second cut cattle, whatever that is. But it's just so then we have a consistent average price that you would see on those calf settlements. This is just a visual showing you about all the markets that are reporting to price insurance currently. And like I said, we have a very good representation of those sales that are happening across Western Canada. Some of the myths that I'd like to debunk now are that a LPI alters coverage and premiums whenever it suits. And it says SCIC here. Well, of course, we don't administrate it out of the province here, so that's obviously not true. But we have a set methodology, and that methodology has to be actuarially certified as being sound. Therefore, we can do no manipulation of coverage or premiums at any time of when we're publishing. Another myth would be that the LPI influences the cash market and what producers get paid at an auction market for. Again, this is a myth. This is not true. And because it's regionalized, once again, it's, sometimes producers view that as a fault. They wish that we could more localize the insurance. And if we had enough cattle in the system, we most likely could do that. But the amount of data that it requires us to stay actuarially sound is quite mind-boggling. So therefore, these prices are regional. They're not localized. Therefore, it's sure hard to manipulate. Another myth could be the producers have to sell their insured calves within the 4-week claim window. Again, this program was here to designed to protect you against, catastrophic events that could lay out there. And therefore, no insurance policy is going to tell you what to do with your inventory. The whole point of it is, if you are in a position where you do have to sell in a falling market, then at least you have your price insurance to top you back up to where your coverage is. Or the other side is, it would maybe give you an opportunity to be able to buy some more feed, if there's any around, to be able to retain those cattle and wait for these markets to recover. So it isn't attached to your production, as I've stated before. Therefore, you are not required to sell at the time that the policy expires. And LPI does not guarantee a price for your calves, as stated before. So some of the highlights since we've started this program is, we've had, over 22,000 individual qualifying sales submitted, about 48.5 million head reported. This is livestock price insurance as a whole, by the way. It's not just for Saskatchewan. This is the whole program. So we've had, $7.4 billion in liability, and indemnities paid to calf and feeder participants has been just under $97 million. So, the program has been effective, and it's worked when it's been needed, for sure. We also have an industry advisory group. We created this in 2020, I do believe, and it includes representatives from stock growers associations, cattle feeders, LMAC, and representatives from every province across Western Canada, and we meet quarterly. Some of the things that we're working on right now are our feeder program is, being looked at with a fairly narrow lens, and it has been requested to us to look at being able to split our feeder program, to have a fall feeder program essentially, and a spring feeder program. So that would speak, a feeder program that would more effectively cover off those cattle that are being backgrounded, and more effectively cover off the cattle that are coming off grass. So we are currently looking at that. I cannot give any time frame or any decision making at this point because it's currently being analyzed. The other thing that we have been looking at, and we've actually already conducted, is looking at that barley component on the CAF program. It definitely impacted our coverages when we got into that time of these high grain prices. And of course, because we all know what barley did, you know, barley climbed. And so we're just taking a closer look at that just to make sure it's relevant and reflective piece of methodology to the CAF program. So in summary, what I leave you with, even though we are in this really awesome market today, it's very important to know that you can't protect what you don't measure. You have to understand your cost of productions, know your cost of productions to be able to effectively use any risk management tool, whether it's price insurance or contracting the cattle. Cattle markets are volatile. Prices are great today, but the fall run is a long ways away in the terms of markets. And please do not be a repeat offender or have short-term memory loss. The last time we seen a rally such as this was 2014 and 15, but you have to, don't forget that what happened in 2015 going into 2016 and the massive market decline that occurred. In 2016, we were in August forward selling calves on team for $3. But come time of delivery in November, that market had dropped under $2. It was the difference in the high of that market back then to the low that we ended the year in 16, I do believe. But I know the difference between that from a dollar perspective was greater than the BSE devastation. From highest level of market price to the lowest, that cash difference was bigger than we ever experienced in BSE. So don't forget that. Don't forget that even though we look this just, yes, the markets are fantastic, but they're also fantastic to protect. And especially in a case of the livestock price insurance tool that allows you to establish a floor and leaves you potential to go higher. Is it going to go higher? Are we going to get, where's the high going to be? I'd really like producers to weigh in on this conversation as I wrap up and give me your thoughts. And again, they're only thoughts. If we could predict exactly what was going to happen, then of course we wouldn't need price insurance. Come and visit our website. Lots of good information on there. I mean, now more than ever, you need to be looking at this for sure. Here's my contact information. Take a picture of it, write it down. You can reach out to me at any time. I really appreciate you joining me today. I'm sorry that I didn't get into the forage insurance as much. That's also a very important tool. And I will be able to offer up information on that as well. And maybe I'll work with Jennifer on that so that we can add that in. So I apologize for that, but thank you. How did I do, guys, for time?
I think we're right on schedule. I think we're good. So thanks, Jodie. We're ready to take questions. So if you haven't already done so, you can type your questions now into the question box. It should be in the bottom right-hand side of the control panel on your screen. And I've got a question for you, Jodie. So I'm wondering what, at the end there, you wanted to pose it to us, but I'm kind of wondering, what do you think is going to happen? Do you think in those coverage levels are going to go a bit higher than 304?
I wish I had an answer for you. The way these markets are moving, like, I can say this because I got a Saskatchewan crew here. It's just like telemerical, the way these markets have been moving, right? Are we going higher? Are we going higher? I said that all weekend long, like as we watched a little bit of inserts of telemerical. And what's the limit? Again, like I stated, we are in new historical zones. We've never offered insurance at this level at this time of year. It's March 1st. And so is this thing going to go higher? Maybe. I don't know. Like, I question, when do we test those markets? Like, when do we tap that out? And again, I think if I had those answers, I wouldn't be sitting here as a coordinator. I'd be sitting somewhere with a Mai Tai on my hand and Mai Tai on my hand, watching the waves of the ocean come in, right?
One question we got in, can you remind us of the deadlines to purchase forage insurance? I know we didn't really talk about that, but do you have those?
Yes, I sure do. So it's the end of March. It's just like crop insurance. The deadline for the forage rainfall program is the exact same as crop insurance. And the deadline for purchasing price insurance is June 8th. So yes. And we would have just announced our coverages for the forage rainfall program as well. And so I really do apologize for that. There's a lot of information. So I'm sorry that I didn't have that for you here today and in the interest of time.
No, that's all good. There's another one here. I don't know how to make my screen bigger, so it might sound a bit choppy. So there are obviously several costs to production and opportunities for insurance. What do you recommend to cash flow these opportunities, or is there a best way to determine what fits your operation?
Well, and that's a super good question, and that goes back to that statement that I made about, like, you can't measure what you don't know. Like, so that goes back to your cost of production piece, and the reason why the premium table looks the way it is because that is just the variance there is for our cattle producers on cost of production. We're in a situation right now that I would dare say doesn't matter the level of participate coverage you're selecting, you're most likely protecting margin. That bottom coverage of $1,624 probably does still speak to some margin in there. So that's the greatest scenario you could be in. How much margin do you want to protect? And I think that's the beauty of where we're in this market right now. You're safe at pretty much any level on that premium table. So, if everybody's strapped for cash, I understand that. So maybe when you can do it for under $20 a head, quite a bit cheaper than a Draxon shot, as I always refer it to. That middle row of the coverage, and then of course to the bottom, is cheaper than our vaccination shots. So, and that's a part of doing business. So, if that's it. And then when we get to that, higher coverage, when we talk about that $1,800 a calf, like, my goodness, like, $48 from a cash perspective, that's expensive. But again, from the insurance world, like I showed you, at being at 2.5%, it's also fairly attractive when you look at it that way. And being mindful of that you don't have to pay for these premiums until such time your policy expires. You're not required to pay that premium up front. You can pay for it once that policy does expire. That gives you that time, and when you start to have cash flow coming back in. So I hope that answered that for you correctly. And feel free to ask another question if I didn't.
Another question we got, how are LPI premiums and benefits dealt with in agri-stability?
Oh, excellent question, because premiums on livestock price insurance is 100% paid by our producers. We do not cost share premium like we do with our other BRM programmings or other insurance programs. Therefore, you are exempt on your agri-stability. Your LPI is treated differently, it's not penalized per se on those indemnities like your other programs would be, such as crop insurance or your forage insurance. Of course, your forage insurance is a cost share. So yeah, so price insurance is viewed differently with agri-stability. Sorry.
One more question here. Does the payment for forage insurance differ? Do you pay at the time of purchase or afterwards, like with LPI?
Yep, same thing on your forage insurance. So what happens is it gets paid out at the time of when your policy is done on your rainfall insurance, because you have a varying ways of selecting that coverage, be it your weightings as to what months you want to weigh heavier for that moisture, weather stations, and so forth. But once your policy is done, if you are in a claim, then they circulate the payment out immediately, just like Price Insurance does. So you have that. And of course, same thing as Price Insurance, that your premium is not due in full until such time the policy, like in the fall, like when your policy is done. So it's another one is you don't require to have that payment up front.
Okay. That's all I've got for questions for now, but I do have one request in the chat. Can you put your contact info back up on that last slide? Anyone who wants it can grab it.
Absolutely. Did it come back up?
Yes. Yep, it's up. So at this time, we'd like to thank everyone for joining us for session 2 of Ranch Management Forum, and a special thanks to Jodie for her presentation today. There's going to be 3 more sessions next week, March 7th, 8th, and 9th. So get signed up for them in advance. And if anyone has any further questions regarding this topic or other ag-related questions or inquiries, please contact your nearest Saskatchewan Agriculture Regional Office or call the Ag Knowledge Center at 1-866-457-2377, or you can visit our website at saskatchewan.ca/agriculture. Thanks again for joining us today, and have a great afternoon.
Thanks, guys. Thanks, everyone.
There is one technical question left in the chat there, just asking about a recording. So just to remind everybody that yes, the presentation was recorded today, and it will be sent out within about 24 hours of the presentation.